If you don't invest your money and get your money to start working for you, it is nearly impossible to get ahead and to achieve your financial freedom. There are tons of different ways to invest, and understanding these strategies can be confusing, especially to somebody who's just starting out. The only type of investing that has ever made any sense to me is value investing. So in this video, I'm going to discuss what value investing is. I'm going to talk about the evolution of value investing over the last 100 years, and I'm going to share with you my top tips for getting started in value investing today. So stick around and let's dive in. Hi everyone, I'm Chris, and thanks for tuning into our channel where we discuss achieving wealth and financial freedom through a three-part strategy. Earn more, spend less, and invest the rest. If you like this video, please help us grow by subscribing to our channel. So we are a channel that takes a holistic approach on personal finance, but everything we do centers around the principles of value investing. It isn't an exaggeration to say that value investing has completely changed our life. And in fact, learning about value investing and the power of compound growth is what has motivated Sam and I to completely overhaul our financial behaviors and dedicate ourselves to earn more and spend less so that we have more to invest and grow our wealth. The idea for this video came to me a couple of weeks ago when I was having coffee with a friend. I was going on and on about value investing this and value investing that. And he said, wait a minute, what exactly is value investing? And it made me realize if my friend had this question, there's probably a lot of people out there that had it too. Hence this video. So let's dive in and I hope you enjoy. Let us begin with answering the question, how do you define value investing? Some define value investing as buying companies based on a low price to book or a low price to sales or some other valuation metric. But to us, value investing is about using the fundamentals of a business to determine its intrinsic value, then using market inefficiencies to buy these businesses at a discount to that intrinsic value. The best way I can explain it is to understand what a company is worth as confidently as you understand what this $20 bill is worth. If somebody is selling this $20 bill for $10, you should buy it. And if they come to you the next day and offer it to you for $5, don't be upset that you bought it yesterday for $10. Be happy that they're offering it to you at a bigger discount and buy more of it. Now, Warren Buffett often says that when he buys into a business, he wants the stock price to go down. Most people don't understand this, but this is because Warren Buffett understands the value of this business just like we understand the value of this $20 bill, and he wants to buy it at a bigger and bigger discount. So this leads me to the next important question. How do value investors value a business? Like I said, there are several different valuation methods, but value investors are looking to buy productive assets. These are businesses that are going to produce cash year after year. And the intrinsic value of this business is just the future cash this company is going to produce, discounted back to today's price by an acceptable annualized rate of return. So most people consider Benjamin Graham the father of value investing, and he honed most of the principles of value investing after experiencing the crash of 1929 and investing throughout the Great Depression, where he earned an absolute fortune investing in companies that he saw as being sold at a discount to their intrinsic value. Now, Graham was investing using what's called the net-net strategy. This meant that he was buying businesses for equal to or less than the amount of cash they had on their books minus the total liabilities. Now, he was investing during the Great Depression, so he was able to buy hundreds and hundreds of stocks at these types of valuations. We don't really have an opportunity to do that, so it's a little bit different than when he was investing. Now, Graham wrote the foundational books of value investing, like Security Analysis, that he wrote along with David Dodd, who was a fellow professor at Columbia University. He also wrote The Intelligent Investor, which Warren Buffett read at the age of 19 and said was the most influential book that he's ever read. So Graham was really the first to discuss the notion that stocks had an intrinsic value and that you were actually capable of buying these stocks at a discount to this intrinsic value. Before Graham started discussing this, investing in the stock market was seen as a highly speculative endeavor. Now, Graham was a strong proponent of efficient markets, though it's important to note that he saw markets being efficient in the long term, but very inefficient in the short term. Human emotion is what pushes stocks up and down, swinging around their intrinsic value like a pendulum. Now, Graham said in the short run, the stock market is like a voting machine, tallying up what firms are popular and unpopular. But in the long run, the stock market is like a weighing machine, assessing the substance of a company. Now, value investing has evolved since Benjamin Graham, and the best way to trace this evolution is actually through the life of Warren Buffett, arguably the best investor in history and a student and an apprentice of Graham himself. Ooh, evolution. This might take a while. I'm gonna go get a coffee and get settled in for this one. All right, so I've got my coffee and I'm settled in. And we're back to Warren Buffett. So as the story goes, Warren Buffett first came across Benjamin Graham at the age of 19 when he accidentally bought Graham's book, The Intelligent Investor. Now, I don't know how you accidentally buy a book, but Mr. Buffett, if you're watching this video, if you could leave a comment in the comment section below, tell me if this is in fact true or if this is complete internet hogwash, I would really appreciate it. Also, if you have a chance, could you smash the like button? Now, Buffett later attended Columbia University where he earned a master's degree in economics and had Graham as a professor. This is where they really established a deep relationship and Graham became his mentor. After this, Buffett actually went to work for Graham at his investment partnership, and this is where he learned a lot of the fundamental analysis that he still uses to this day. After Graham shut down his partnership and retired, Buffett started the Buffett Partnerships with some money from friends and family. The partnership grew along with Buffett's wealth as he practiced what Graham had preached. The Buffett Partnerships returned more than 30% a year for the 12-year history of the fund, investing in the deep value investments that Graham was famous for. After 12 years of running the fund, it is believed that Buffett grew tired of dealing with his investors, so he closed down the fund, returning all the current holdings of the partnerships to the investors. This included shares of a mid-sized textile manufacturer out of New England that Buffett had slowly been building a position in. The company was Berkshire Hathaway, and this is what started a 55-year adventure from turning a mid-sized textile company into one of the largest and most diversified companies in the world. It was also during this time that Buffett partnered with Charlie Munger, who was also from Omaha, Nebraska, like Buffett. Coincidentally, Charlie Munger had worked for a small grocery store as a young man that Warren Buffett's grandfather actually owned. It was actually Munger who impressed upon Buffett the value of quality businesses, and it was Munger who said it's better to buy a great business at a fair price than a fair business at a great price. Since 1965, when Buffett started buying Berkshire Hathaway, the company has been able to compound money at a whopping 20.3%. This means that a $1,000 investment in Berkshire Hathaway in 1965 would now be worth $26 million. Nowadays, there are slight divergences into different value investing strategies, but what unites all value investors is that we refute the idea of the efficient market hypothesis. The efficient market hypothesis essentially says that all known information about the stocks is already factored into the price of those stocks. Therefore, if we assume that this is true, then no amount of fundamental analysis will give an investor an edge over any of the other investors or the market as a whole. And therefore, beating the market over any long period of time can only be explained by luck. The Super Investors of Graham and Doddsville was an article written about a speech that Warren Buffett gave to Columbia University School of Business in 1984. This was the 50th anniversary of Benjamin Graham and David Dodd's book, Security Analysis. The speech and the article challenged the idea that equity markets were efficient by looking at 9 successful firms generating long-term returns above the market index. These investment funds were all practicing value investing principles, they were all managing concentrated portfolios, and they were all had a track record of crushing the S&P for decades. Now, how could this be luck? Value investing firms all practicing the same principles and crushing the market for decades? That can't be luck. So is this investing style obsolete? I don't think so. There's a new class of super investors that have had amazing success practicing the principles of value investing. Investors like Monish Pabrai, Lee Liu, David Einhorn, Bill Ackman, Seth Klarman, Phil Town, Guy Spear, and let's not forget Warren Buffett and Charlie Munger are still doing their thing. These investors are all disciples of Warren Buffett and Benjamin Graham. They all practice value investing principles and they manage concentrated portfolios, meaning that most of their portfolios funds are in a handful of stocks. The fantastic thing is that all of these investors are managing more than $100 million. So that means that the SEC requires them to file what's called a 13F filing. This is a quarterly filing that shows what they're currently holding in their portfolios. That means that you will know within a couple of months what they are investing in. According to a 2008 paper titled "Imitation is the Sincerest Form of Flattery," Warren Buffett and Berkshire Hathaway had you have copied Berkshire Hathaway's investment portfolio from 1976 to 2006, making your trades the month after they were publicly announced by Berkshire, you would have beat the S&P 500 by over 10% a year. So I think this shows you the power of value investing and how it is an amazing tool for growing your wealth. So that brings me to my tips for how you get started into value investing today as a beginner. All right, number one, get reading and educate yourself. Don't just take my word for it. If you want to take responsibility for your financial future, you need to take responsibility for understanding your investment strategy. There are lots of great reading resources out there, and in the description, I'm going to give you some links to my favorites. But if I had to narrow it down to 3, here they are. Okay, so the first one will be Rule 1 by Phil Town. This is a great place to start to learn how to actually value a business. And like we said, this is paramount in being a value investor, is understanding what the value of a business is. Okay, and if I had to give a 1B, I'm going to also stick with Phil Town and say invested. Now, this is really nice because he partnered with his daughter in writing this, and she was very new to value investing. So it shows her journey through the process of educating herself in the principles of value investing. Okay, so the number 2 thing I would recommend everyone who's going down the path of value investing to read is anything and everything written by Warren Buffett. So the easiest thing to do is to go onto Berkshire Hathaway's website and download the letters to shareholders. So I've got a book here that has them consolidated from 1965 to 2014, but you can go online and get every letter from 1965 to the one that he just released last month. So this is 55 years of amazing content that you can sit there and read. And what's amazing about this is, like I said, Berkshire Hathaway in 1965 was a small textile manufacturer in New England, and now it is one of the largest companies in the world. And you can sit there every year and read how he did that, and it is amazing. So the other thing I would also say, if you are pretty good at doing some research on the internet, you can come across the letters to investors that he wrote to his investors in the Buffett partnerships. So this was 12 years of more great content. And like I said, the Buffett partnerships returned over 30% a year for 12 years. So it was amazing investment results. And he goes through and explains his investments. The other thing I love about it is Einstein said, you know, if you can't explain something simply, you don't understand it well enough. Well, this demonstrates how intelligent Warren Buffett is when it comes to value investing, because he explains it so that anybody can understand it. It is an amazing place to start in value investing. So my third reading recommendation for anybody starting down the path of value investing is An Education of a Value Investor by Guy Spier. Now, Guy Spier is one of the super investors I've talked about. He manages the Aquamarine Fund, which manages well over $100 million. And this book basically details his journey from a more traditional Wall Street background to be more of a value investor like Warren Buffett. There's a lot of great value investing principles in this, but there's also some life principles that I really enjoyed reading. Okay, my number 2 tip in starting down the path of value investing is just to open up a brokerage fund and start to put an automatic transfer into it every month. Even if you're not ready to invest, it's a great way to allocate some capital to your investments and put it away so that you're not spending it. Okay, so tip number 3 is just to start practicing valuing businesses. Like I said, that is the cornerstone of being a value investor. You want to understand a business so well that you can understand its value, just like you would understand the value of a $20 bill. This does take work, it does take practice, it does take time, but when done correctly, it offers amazing returns. Okay, tip number 4 is to build a watch list of great businesses. So these are companies that you're going to understand, and these are companies that you can put a fair value on. Okay, and number 5, just be ready to strike when the market offers you a fair price for stocks that are on your watch list. All right, everyone, that's it for me, but I want to leave you with one final quote, and it's from Warren Buffett himself. He said that value is what you get, price is what you pay. Thank you so much for watching. If you like this video, please let us know by hitting the like button, or better yet, subscribing to our channel. As always, feel free to leave us a comment if there's a question that you have, or if there's a topic that you would like us to cover in an upcoming video. Remember, Earn more, spend less, and invest the rest. And we'll see you next time.